Okay, hello. Oh, do I need to unmute you? Oh, here we go, you're connecting, okay.
Hello, hello.
Okay, let me close this door. I'm like totally wearing like bedtime socks, but I'm business on the top.
I told Amber, I said, whenever she asks me what's new from last week to this week, I'm gonna be like, well, I am wearing pants today.
That is such a good, we have to do that, you have to do that. Okay, so I just want to make sure I'm. So this is what I made the mistake of last time. I recorded it where it was both of us being recorded at the same time, and I really want it to be where it's just recording who talks, because I had to go edit that, and it took me a long time. So I think I have it now where it's speaker view, so it should only be recording who's talking, so we're just gonna wing it.
Okay. How's my face? Am I too shaded on one side?
Oh my gosh, you're so dark on one side.
It's because I have the door to the outside right here, and then the kitchen's over here. So I'm not really.
You need like a beauty light.
I know. I'm trying to. It'd be nice if these lights worked right here. I don't really have anything else to work with. Hold on, I'll be right back.
Okay. I think it's going to record who speaks. I think that's how it works. I'm going to hope that that's true.
Oh, of course, the cord I have isn't long enough. Hold on.
Did you think my question of a lot of people would surmise those with middle or lower class income are having to tighten their purse strings due to the pandemic? My question is your experience contradictory to this, and actually you're not seeing a slowdown of receiving applications from all income brackets? Is that politically correct? Oh, I don't think you heard. Maybe I should ask it differently. Should I ask the question about income brackets a little differently so it doesn't sound, is it like not PC the way I asked it?
Read it to me.
I said, now it's understandable that a lot of people would surmise those with middle or lower class income are having to tighten their purse strings due to the pandemic. My question is your experience contradictory to this, and actually you're not seeing a slowdown of receiving applications from all income brackets? Should I say, instead of that, should I just say, a lot of people would surmise that everyone's having to tighten their purse strings. Is your experience contradictory to this, or are you actually not seeing a slowdown of applications? Maybe I'll say that.
Okay.
Yeah, let me just take that part, because I'm feeling really bad about that. I feel like I should.
I'm not, so word it this way. I'm not seeing any slowdown in any applications from any particular class. I'm actually seeing probably more applications from the lower income right now. It's the credit standard that's changed. So we are turning down a lot more applications that are coming in.
Oh, okay. So what if I say it like this? It's understandable that a lot of people would, I'm going to say assume. I know you're not supposed to use the word assume, A lot of people would assume that.
Are you seeing a difference in the amount of loans that you guys are approving?
That's it. Okay.
Approved?
Are you seeing exactly? Okay, let me just.
Dang, that beauty light's on point.
Mine or yours?
Mine.
Oh, yours, it looks great.
Forget yours, Victoria. This isn't about you, okay?
I know. I was like, it's to be expected that I have a beauty light because I'm freaking married to a photographer, but yours is doing fantastic.
It's a little bit yellow, but you know, I'll take it.
I love it. What are you using?
Basically, had a little lamp in a room. I just hooked it up and turned it on.
I love it.
It was either that or I was going to turn my phone light on.
So are you seeing a slowdown of approving applications? Should I just say that?
Yeah, or slowdown of loan approvals.
I'm going to say, okay, loan approvals. I'm going to say that, loan approvals. Okay. I told my computer to do this in speaker mode, like speaker. So I see myself as a little person and I see you as a big screen. So I'm really hopeful that the recording is just who's talking at the time. Otherwise my tiny little head's going to be on there the whole time. And we might have to do this again. All right. You tell me when you're ready. Oh, let me silence my phone. Yeah, just in case.
I'm just turning my light off because that didn't help at all.
Oh my gosh. Okay, silence our phones. Are we ready?
Yep.
Okay. Hi, Todd, and welcome back. So thanks for joining me again. For those of you who weren't here last week, Todd and I sat down and talked about some of the most common questions that I've been receiving from my clients, my friends, and even my family regarding all this COVID-19 and how the real estate market is essentially responding to it. So if you haven't already checked that out, go to my YouTube channel, watch that. This is what I'm calling Talks with Todd the Lender, episode 2. So thanks again, Todd, for coming back and spending some virtual time with me. How are you doing?
I'm doing great. Thanks for having me back. I appreciate it.
Good. I'm so glad to hear that. So before we jump into the questions I have for us this week, are there any updates that you want to bring to us from last week?
I think from my standpoint, just in an office setting, you know, I did upgrade. I made sure on all my Zoom calls I am wearing pants this week. So I'm trying to get better and get back in the swing of things as we get closer to hopefully the market starting to open back up and people being allowed to go back to work.
Oh my gosh, that's amazing. I know, just adjusting back to some normalcy. I think it's gonna take a bit of a transition period. So I'm glad to hear that you put pants on.
Yeah. But I think as far as our market goes, we are hearing today, I did on my call that I do in the mornings, I heard that the feds, there's some grumblings out there that they are coming up with a solution to deal with all of the forbearances that they've allowed within the mortgage housing market. As I mentioned last week, we're going to have some issues with that if they don't take care of things, because those companies that take care of the servicing, they still have to make those payments to the investor. So if the feds don't come up with some kind of a repayment plan, a structure for them, the industry could be hurt really, really hard. So that's exciting news. That's the news that we've been begging for the last several weeks. That was going to be probably the number one thing that would topple our market if there was any one thing out there. So I'm excited for that. Hopefully we'll get some news by the end of this week so I can have something to share with you next week.
Wow, that's awesome. Thank you so much. I know that's a huge looming question right now, because just like what you were saying, it is going to affect our market for the future. So knowing how the forbearances are being handled and what their plan is, I'm so happy to hear that. Thank you for that news. So I look forward to next week when we have a little bit more info to share on that.
Yeah, let's hope. I mean, the federal government, let's be honest, they don't move too quick. So I'm just fingers crossed that we have some kind of an idea of what it's going to look like. As far as how it's going to hurt or help our market, we probably won't know that until early next year.
Definitely. Well, thank you so much. Any information, especially from someone like you with all the resources at your fingertips, we appreciate it. I appreciate it. So thank you. I definitely look forward to talking to you more about that next week. So Todd, I recently sent a link from a news article to you, and I actually sent it to you because I wanted you to read it and fact check it. I always send things to you just to make sure that it's, you know, a trusted resource and trusted information. So I'm just going to kind of go into that a little bit today. So it was written by a woman named Stephanie Bedard Shatofna, and she's actually based in Canada and has been writing about the financial markets and stocks for several years. She did receive an MBA in finance and worked for the National Bank of Canada. And the reason I'm bringing her up is just to show who she is and give her a little bit of credit for that her voice would actually be worth listening to. So the article I sent you, it was entitled, "The U.S. Housing Market Crash Looks Inevitable as Mortgages Become Harder to Get and People Have Less Money to Spend Due to the Pandemic." So I'm going to be using these talking points, prompting our questions today. So starting off, she's stating that the housing market crash is inevitable due to it becoming harder to get mortgages with lending criteria tightening. Can you speak to what specific criteria is tightening for mortgage approvals and why?
Yeah, I did read the article. Not a bad article. I think the problem that we're running into right now on some of these articles are the headlines. The headlines of these articles are sensationalized because that sells the article. The housing market crash looks inevitable. I don't know how you predict a housing market crash. It's nothing like the last market that we suffered back in 2006 to 2008. That was because of guideline restrictions, because things just got a little loosey-goosey out there and everybody was lending, didn't matter what your situation was. That is definitely not the case this time. This is something that has nothing to do with our market or any other market for that matter.
Right.
And this is a pandemic that really only China could control, and they lost control. So to say that the market is going to crash, use that word crash, that's a little over the top in my opinion, as are most of the articles that you're going to see.
Definitely strongly worded.
Exactly. To lend credibility to the article itself, a lot of the data that's used on a national level is pretty spot on. I can't say that, again, on a national level, I can't say that I disagree with really much of anything that she had to say. With what I'm seeing in our market and the changes in our market, it is a restriction to the client. So credit restrictions, we're seeing, where we could do a loan to 580, now it's 660. But there's a lot to that. To elaborate further on it, it has more to do, there's more to it than just this market because of COVID-19. There's several other items that caused this. And, a lot of it had to do with our refinance boom that we had back in the middle of March.
Mm-hmm. Definitely. No, I appreciate that. And I think, I was reading it and I am definitely understanding, like you said, what's getting people to click on an article is how they're wording it and how they're titling it. And someone had sent it to me. So I thought, well, if I'm going to have any ammunition and any truthful information to essentially rebuttal this, I better ask Todd. So I did appreciate that you read it. I know you said there was, on a national basis, a lot of information that is definitely valid and can forecast. But of course, the word inevitable, absolutely, who can really predict that? And we talked about the crash, last week. So I appreciate you touching on that one. So kind of jumping from that point. So are you seeing a slowdown of loan approvals right now?
I am. I would say the normal lead generation that I'm seeing has slowed down a little bit. And we did, the existing housing numbers did come out today, and they are lower. And we expected that. Are they a lot lower? I would say by what we're seeing as a whole economy, not too bad. And a lot of that is because we had such a great market going into this issue. So I am hoping, and again, I am definitely not the foremost expert in the industry, but I'm hoping that on a local level, at least, we aren't going to see the crash word happen. Again, there's a lot of variances that fall into that. When we are seeing the applications being turned down, most of it is still credit driven, because again, there's a big clientele from that 580 to that 660 number. For example, I've had 3 applications this week that fell just shy of that 660. I can do the loan, but the pricing is so ridiculous, it doesn't make any sense for the customer to do it. So where at that point we go into a coaching status where I refer them over to some sources that I have to help them get those scores up, from maybe the 640s to the 660s. Doesn't take too long, and then we'll approve those at that time. So again, like we're seeing with a lot of the issues right now, it's not a no, it's just a not right now. Maybe
Okay.
2 months, 6 months, somewhere around there.
Okay.
The people probably directly affected by this market itself, meaning the COVID-19 market, as I like to call it now, is people that have lost their jobs. That's going to be the most direct impact beyond the credit situation. Obviously, if you don't have a job, you can't get a loan. So there has been some additional criteria on our guidelines, such as like a lot of refinances that I had going. They all have to have an updated pay stub at closing. And that's from our investors, because they want to make sure that those people didn't lose their job from the time that we started the loan till the time that we finished the loan, where in most cases we would never even request another pay stub. So we're also having to get a verification of employment done, which that verbal verification normally had to be done 10 days before it closed. Now it has to be done the day before.
Oh,
So
wow.
they've tightened a lot of that up, and that's because obviously we're seeing in the market there's 20% unemployment on a national level. So it's something that we have to, look at and be
Right.
cautious with.
Okay, well, thank you for that example. So yeah, because she mentioned, the tightening of the criteria. So that actually makes perfect sense, because obviously on the investor side, they do have to go and do their due diligence to make sure that their investment's protected. So that actually really translates very
Right.
understandably.
Yeah, and it comes from, they don't want to fund a loan and then have an immediate default. And so that's why if they increase their credit standards and then they verify the income and the job status before they close, it just hedges their bet to make sure that they're not going to be stuck with a mortgage 3 months down the line when they haven't made a payment on it. So it does make a lot of sense when you think about it in the grand scheme of things.
Yeah, definitely. Thank you for going into detail on that. So as we've already discovered, so no one has a crystal ball. We can't predict. We can just speculate based on facts, what's going on right now and what we've seen in the past. So we did touch on this a little bit last week, but would you again for us just articulate what the difference in the market was leading up to the actual market crash, to like basically differentiating between then and now? I know earlier you kind of mentioned they were just kind of giving loans out to anyone. They weren't as strict. They didn't have these guidelines. So can you also just touch on a few more specifics where it's not looking like the same story?
Yeah, when the servicing's going on, there's a lot of hedging that happens. In the last market, it was every servicer was hedging their bet. And then finally somebody was like, I want my money. And these homes were already in default. And so then there was a run on the banks. When there was a run on the banks, they didn't have the money. And if you can't fork out the money to pay those debts off, then you got to go bankrupt. So you saw big banks like Washington Mutual, that folded and then ultimately being sold by the government to Chase for pennies on the dollar. That salvaged a lot of that market. And you just saw this going on and on, countrywide, getting eaten up by Bank of America, so on and so forth. So now it's completely unrelated to the way that the loans are structured. There's no shadiness going on. There's nobody that's just making loans on paper with, if you can fog a mirror, you can buy a house. That's, in essence, layman's terms, that's what happened back in the early 2000s. Now everybody's still very well qualified. I mean, even the first-time homebuyer programs, the majority of them have a 660 requirement. So these first-time homebuyers have to have decent credit, and a 660 credit score on a young person that's buying their first home is very good credit. They have no lates. It's just young credit. So I'm even on these conventional loans, I'm seeing a lot of reserve requirements. I'm seeing loans that are requiring that customer to have 2 months reserves or 3 months reserves before we can approve them. It's just strictly the change now was, the first change was the market got inundated with refinances, because as this started to occur, anytime there's bad news, the bond markets adjust. And when the bond markets adjust higher and the yields drop, our rates drop. And we saw rates drop a full % within 2 weeks, or actually within 2 days, I would say. It happened really, really quick. and on the 15th of March, we saw the best rates that we've seen in history. So we were inundated with applications. That puts a run on applications on all the investors. Easiest way for them to slow that down is to jack up their interest rates and mess all that up. So that's harder for us to make loans and get them locked. That slowed that application down. Well, then as the market starts to deteriorate more because of COVID-19 and people are losing their jobs, that just adds to that. As far as the way the bond markets look right now, we should be interest rates in the twos. I mean, the standard thought process and the way that we look at the markets, we should have tenfold the best rates we've ever seen. I mean, we should be doing so many refinances that it'd make your head spin. But we're not doing them because the interest rates are still higher. They're not bad. The interest rates are still great, but they're not better than they were a little over a month ago. But the Feds are doing a good job. They're buying mortgage-backed securities to stabilize the market right now, which is allowing the pricing to come back and become a little bit more normal. I am seeing applications starting to occur again. Again, they just have to pass that criteria set by the investors because of understanding that a lot of people have lost their jobs, whether it be, short-term or long-term.
Mm-hmm. Definitely. Yeah, no, thank you so much. And I think that's one thing that I have wanted to be able to almost paint the picture for my clients is the difference of what's happening now to what happened then. I think that's really my most common question, this, looming crash. So thank you so much for speaking to that. My last question for you, Todd. So we talked last week and you mentioned that the mortgage rates are still looking really good. You foresee them holding pretty well for a few weeks. So is that still what you see the market is indicating?
Yeah, I locked 2 loans today, actually. The Feds have been buying about 15 billion in mortgage-backed securities. Mm-hmm. There is understanding that they're going to drop that to 9 billion. So they're kind of taking the training wheels back off and they're going to let us duke it out and see if the market can stabilize on its own. Right. So there's a little bit of fear on my part. So I went ahead and locked those clients that needed that lock. I locked one today at 3.5% with a 1 point buy down. So it wasn't too bad. Client was extremely happy with that number. It was lower than what I had originally quoted them, a little over a month ago. So it worked out in their favor. And I did a first-time homebuyer program at 3.25%. So that's really good. They were still extremely happy. And that's lower than what I had quoted them at 3.5 originally. So I'm still getting people what they want and then some. It's just a matter of whether or not they can qualify. So that part is really good. There is definitely, to kind of go back to what we were talking about, there is a lot of sentiment out there right now where people are fearful. They remember what happened in the early 2000s.
Absolutely, yeah.
And so there is a genuine fear, and I do get those phone calls, and I welcome those phone calls, so I can explain to them that crash is so much different than this crash. We saw guidelines change on the same product every day for 2 years. It was something that, I mean, it's like playing darts with a dartboard moving constantly. It was impossible to play the game at that point. And it made my job extremely stressful. So this time we don't have that. We saw income guidelines didn't change. That stays the same. We saw debt to ratio guidelines go from 45 to 43 on our first time homebuyer programs. 2% is not a big deal. It just strengthens the file, makes it to where they've got a little bit more leverage. And then they increase some of the credit guidelines. And I mean, going back to that article, it's specifically talking about Chase, because Chase was the first big bank to say, we're not doing anything under a 700 credit score with 20% down. Well, that's just Chase. We're talking about one bank.
Right.
Bank of America, similar. So when people call me and they're like, oh, well, Chase has better rates than you, which is almost never. But again, Chase can't get the deal closed. They don't want those mortgages right now. The big banks, they've got plenty right now. They're good with the refinances that came in. So they're going to pump the brakes, slow down, and wait until people get their jobs back. To kind of put an emphasis on that job loss situation, because again, that's the part that everybody's really freaking out about. Right. a lot of people are getting furloughed or are just flat out losing their job, being laid off. So when somebody's furloughed, I'll use my mom as an example. She just did a refinance and she was furloughed on her job. So she was temporarily laid off. Because we have to get that pay stub right before they close, they were in the middle of a refinance when it occurred. As soon as she went back to work, we got her first pay stub and we funded the loan.
Oh, wow.
So once people are back to work, those that are back to work for the same company in the same line of work, we just pick right up where we left off. Those people that have lost their jobs and then eventually go back to work, once they're on the job for 6 months, they're eligible to buy again.
Oh,
So
wow.
this is a market that once things get going again, we could see it recover anywhere between 0 to 6 months, just depending on those people that are buying and if they were furloughed or if they flat out lost their job. It just depends.
Wow. That puts it in perspective as far as the timeline there, because I actually was unaware that it would only take 6 months to get them back on track to potentially get approved. So that's really huge and beneficial information for anyone out there needing to potentially put on hold their home buying process, and then just know that, in less than a year, you could pick it right back up.
Yes, absolutely. And again, there's a lot to be said about who you work with as well. And that's why I always, and whether it's me or somebody else, as long as you work with somebody local, there's other institutions out there. Seasonal income is a big one right now. And we've got companies that will not approve somebody that's off their job right now, not understanding that they would normally be off their job this time of year because they're a seasonal worker. So they're just flat out declining them. Whereas at our company, at Vero Mortgage, we're still going to approve those people because we look at their 2-year history. They've got the same 2-year work history. They're off at the same time of year. They're still getting that benefit that they would normally get this time of year. So literally nothing has changed. So we're still getting those approved, whereas some investors aren't. I heard another lender recently that simply put it, you can talk to 5 different lenders and get 5 different answers. And he was absolutely correct. I cannot disagree with him at all. So just make sure that, anybody out there listening, if you need a second opinion or you feel like you need a second opinion, get it. Because you never know when that other local lender can do that loan or has a different option for that loan.
Absolutely.
I know there was a couple other things that we were curious about with regards to that article also. I would advise people, just be cautious with what you're reading. You've got somebody that wrote an article from another country, not from the United States, generalizing the market, talking about unemployment rates. National unemployment numbers do not necessarily translate to local unemployment numbers. And even within our own county, which is Tulare County, the unemployment numbers in Porterville and Farmersville and some of those smaller areas is much, much higher than the unemployment in Visalia and Tulare. The reason being is most of your laborers work in those smaller communities and they're normally off this time of year. So they're all getting ready to go back to work. So whereas the national average for unemployment's going up, our county could see things start to drop as those people go back to work because they are essential and they will have a job. And that's what makes our county a little bit more unique than the rest of the United States, is a lot of the people that are employed within our county are essential. So when their jobs would normally come back, they will still go back to work. That's not going to change for them.
Definitely. Yeah, absolutely. And I think one big thing I am also driving home with my clients is always consider the source. Who are you talking to, listening to? What article did you read and where did it come from? So, with this Stephanie person, she is in Canada. And, yes, she's been writing about financial markets and stocks for years. And so, yes, I want to hear what you have to say. You're obviously in the industry, but just like you said, keeping it in perspective for our market specifically, every area has to take into consideration what their market is doing, their data, their trends. And of course, what I'm doing now, which is, consulting someone who's in the mortgage side of the industry, funding loans in it daily, and can give us this truthful firsthand information and essentially combat what some, not truthful information might be funneling through, especially on social media.
Yeah, because there are so many factors that, again, somebody from Canada that's educated out of Canada who works in a market in Canada, they know little to nothing about our industry on a local level. So if you do read something and you are fearful, get a hold of a local professional, let them break it down for you, because you never know what bits and pieces of that article are true, overinflated. And like I said, for the most part, her data was pretty spot on to what every other article right now states. And on a national level, yeah, she's probably pretty close, but on a local level, it doesn't mean a whole lot. She talked about how the markets are overinflated by, I think it was 117% or something from the last market crash. As she keeps trying to compare
that word again.
Yeah. Somehow this situation is similar to the situation that we had in the early 2000s when they couldn't be any further from each other. Yeah, there's going to be a slowdown, which means we're going to have more inventory available, but we were already at ridiculously historic lows in inventory. Right. So to say that the market's going to drastically change because of this, if it goes on for a whole lot longer, we'll talk again. But as of right now, I'm cautiously optimistic. And as long as the feds can get our overall market under control and we don't have servicers going bankrupt or out of business, I really am hopeful that we can see things kind of get back to normal within the next 30 to 45 days. Again, we're California, so we'll probably be a little more cautious than some of the other states. But all in all, real estate, we're considered essential. You guys are essential in real estate. I'm essential in finance. So it doesn't impact us. If people want to buy houses, it is still a fantastic time to buy, because no matter where you think prices of homes are, interest rates are so low that they're still affordable.
Absolutely. No, absolutely. Thank you so much. I really appreciate you indulging me with that article and diving into some more information about what's happening related to COVID-19 and specifically our market as well. I appreciate that I can push this information out to my clients and friends and family and anyone else wanting just to keep educated and informed on what's going on as time passes. So I look forward to our conversation next week. Hopefully there's some more information for those forbearances that you mentioned in the beginning of this video. And we can just keep taking it one step at a time, 1 week at a time, and see what happens with all of this.
Absolutely. Thank you so much. And reach out if you have any questions.
Thank you so much, Todd. Once again, Todd Fitton with Vero Mortgage. Thank you for your time. I love spending virtual time with you. So I really appreciate all this information, and I will definitely talk to you next week.
All right. Thank you. Bye.
Thanks. Bye. We did it.
Good job.
Good job. We did it. Okay. Well, I think we got it. I think it was good. I like that, also you said her article also talks, a lot of other articles are going to say the same thing. So that I liked that, because even, a lot of the stuff she was saying, you're going to read it in a lot of other articles too. So yeah. Yeah,
it's right now, and what I'm trying to educate people on, again, that education word is these people writing these articles. If she's got a degree in finance, why the heck is she writing articles?
And that's the thing. What are you doing? Yeah, exactly. And it's being shared on social media.
So, because it's one of two things. Either you sucked at finance and you became a journalist, or you're not a journalist and that's an opinion article.
Yeah,
exactly. Really, I can discredit you on both sides all day long.
Yeah.
I'm not going to, because her data is not wrong. I mean, the numbers that she's pulling from a national average, when I'm listening to Barry Habib in the morning, her numbers mirror his. They're right. But I also see Barry Habib going, oh my God, calm down. That is not the cure-all or the answer to every issue that's out there right now. Mm-hmm. The actual issue is this. None of that has anything to do with our market unless these servicers go belly up. If they go belly up, we're screwed. Then yes, we will genuinely see a crash of some kind. What magnitude, I don't know, but it's going to be pretty rough.
Yeah.
Because now you're looking at a grand national situation. Everybody's going to freak out. Everybody's either going to be selling their homes or losing their homes.
That's what it is. They're going to panic sell.
Yeah, because if the servicers aren't taken care of, the servicers are going to go, F you. I want your house, or make those 12 months payments now.
That's right. That's right.
So the servicers are going to get their money one way or the other. Mm-hmm. And if they've got to fire sell you, they'll fire sell you. They'll tell people, no, I gave you 12 months forbearance. On month 13, I want all 12 months plus that 13th month.
Oh my God.
And now everybody's going to be putting their house on the market. The market gets flooded. The prices tank. We've got to crash.
That's exactly what would have to happen. But that's if there's not good news with forbearances, which I'm hoping that there's some good news.
and that's all I'm listening to right now.
Okay.
What's going to happen on the forbearances? That will tell the story for our market and the future generations that look at this. I looked at the national average for the millennials for unemployment.
Yeah.
4.1%.
Oh, that's nothing.
No, the national average for all unemployment is upwards of 20 to 22% right now.
Well, but that's
so the people that are buying houses
millennials
aren't really that far out of it. Like, yes, they are fearful because they are old enough to remember what happened in 2008, and you got jackals like this lady writing crisis and all this stuff on her articles.
Yeah.
And so they believe everything they read in the media, most of them. So yes, there's panic in the streets, but they all have jobs. So
right.
what it's doing is the panic is causing people to hold on to their money. These millennials just got jobs. They just moved out of mom and dad's basement.
Yeah, you're right.
You know? So now they're like, whoa, I can't get married. I can't buy a house. All these long-term decisions,
right.
They're starting to hold off on them. They're pumping the brakes. They're like, hey, Mom, can I go hook my Nintendo back up and like wait this out for a little while?
Right? Can I just hang out in the basement? You're okay. I stopped the portion of his questions.
What's up?
He just slayed the article you sent him.
I was extremely respectful of that kooky lady, though.
Yeah, he was. He was really respectful, but I could feel it. He was
What's
like,
lady?
the Stephanie chick who wrote that article that you sent me.
The one that got sent slamming Danny.
Oh, yeah.
I mean, I didn't, like I said, I didn't read it all. I just fact-checked a couple of those numbers in there. And I was like,
Well, and that's what he's talking about just now in our recording is that, yeah, the national averages, they match up, but it doesn't necessarily mean for each individual market center it's going to be like that. So.
Correct. And it's right down to rentals. I mean, the numbers that we're going to see on rentals in Tulare and Visalia is way different than what's going to happen in LA and San Francisco.
Right.
You know, LA and San Francisco are going to get slayed in the regular real estate. So there's going to be a flood on the market. You know, the price, I can't even tell you how bad it could end up being. Our market will probably end up being a little more stable. We could even see rents go up a little bit.
Yeah.
You know, with what happens, because a lot of people are going to be, you know, the market shift is going to be so dramatic between the two, you know, and what's going to happen in Texas versus, you know, LA, what's going to happen in anywhere in the Midwest
right.
compared to the East Coast and West Coast. So and unfortunately, I think we're going to see a lot of these political individuals really try and push this out as close to November as possible.
That's exactly what I think. That's what Ricky's mom says too. That's honestly what I think. I think they're going to try to swing this for some political gain.
Yeah. I mean, and if you watch the news for 30 minutes in the morning, it's like all of the Republican governors are starting to open their states. All the Democrat governors are like, I care about the people and we're going to wait this out and see what happens.
Mm-hmm.
Okay. I was telling Amber today, I'm like, you know what? I don't necessarily look down on the desire to be cautious, but when you look at the fact we have 335,000 cases, we have 35,000 cases of COVID-19 in California, but there's 33.5 million people in the state.
Yeah.
That's like what, 0.01% or something like that.
It's really little.
That's an extremely low number of people that are infected.
Yeah, for sure.
And she's like, yeah, but there's a delay on everything. I go, exactly. There's a delay. So all the numbers we're seeing now are what occurred when everything was still open. That's a very small number in comparison to the amount of people that could have been infected.
Oh yeah, absolutely. Yeah.
You know, even if you look at the amount of cases in Los Angeles versus how many people live in Los Angeles, it's stupid low.
Mm-hmm.
You know, I don't like to see anybody die, and I don't want to see anybody get sick, but you're not getting rid of the flu. It's not going to happen.
Exactly.
So I believe there's a conspiracy to kind of push this off to November or as close to November as possible. I do.
Mm-hmm.
Because they don't want Biden talking because he's a bumbling idiot, you know. If it wasn't for who he's running against, I would not have a problem voting for the man. You know, I happen to like Joe, even if he has got some really disgusting mannerisms with how he looks at people and smells their hair, but but when you, and then if they can keep Trump from having rallies to rally the base and keeping them excited, this plays right into their hand and what they want.
That's so true.
And it doesn't matter what they do, it doesn't matter what they say, they cannot make it look like anything other than that.
Yep.
Because it's
That's
only
exactly
one
right.
it's only one side right now that wants to keep the market closed. So we'll see what happens. I could care less what happens as long as our market is taken care of, the mortgage, the housing industry as a whole is taken care of, so that we can all get back to work and go back to things being somewhat normal. I don't know if it's going to be normal for the next 6 months at least, though.
Yeah, I agree. I just want to get back to it. Whatever the problem is, let's be results oriented and just hit it. Let's just get going. Yeah.
Well, and be positive.
Yeah.
Because there's enough of these kooky articles out there that are just so negative, and I'm like, why?
Everyone's getting slammed with it. I know, and why put that out there? Would that help you? Like, why? What are you gonna gain from writing stuff like that? Is what I want to know.
Well, and that lady has nothing to lose because she doesn't even live here.
I know.
She's up in Canada, like, go ahead, close those borders. I don't care.
No kidding, right? That's where she's at with it.
Yeah.
She's trying to build a wall or something.
She's like, I'm going into summertime. Our temperatures are going to be in the 70s all the time. I don't care.
Oh
So yeah, it's just the sensationalization of this is what pisses me off at the end of the day. I'm just like, really, can we just stick to the facts?
Yeah.
And be positive. I mean, let's not be naive. I don't want to be naive to it. Like, had we not closed things when we did, could it have sucked a lot worse? Absolutely, it could have. So I'm never going to say that what they did was wrong. But as far as the outlook, everybody calm down.
That's how I feel.
Let it play out, see what happens, because the stock market's still going up. I mean, it was down to 18.5 and it's at 23 something last time I checked. So, I mean, we're halfway, we're right in the middle of where we started in our low, so it's coming back.
True.
And we're still selling homes. I mean, we're still seeing applications coming in. I'm still doing refinances. I've got another application supposed to be coming in. I'm working on pre-approvals, so there's still stuff out there. It's just, it feels weird now because everything's different. We're not used to handling the business like we used to. I can't just jump in front of a customer and talk to them about it. Like, I got to be careful with everything and do everything over the phone. And, so it's just very uneasy.
Yeah.
And if we can, as professionals, if we can be positive with everybody and kind of the uneasiness, kind of curb that a little bit and let them know that, just because it's different doesn't mean it's not still a fantastic time to buy. Talk to Todd, let him get you pre-approved.
Right, that's where I'm
and
at.
Look at those payments and tell me what you think. I locked that guy at 3.5 today. His payment's $350 less than what it was. And he didn't have a bad rate before. He just has so much better of a rate now, and I got rid of his mortgage insurance. So the affordability is still there.
That's what it is. That's amazing. I love that. If I knew we were going to stay here, I probably wouldn't sell my house, but if I wasn't already a buyer or an owner, I would buy right now.
Yeah. Yeah. If you guys were going to stay, the play is, okay, I have a lot of equity in my home to play with. So if the market drops, am I going to go upside down? No.
Yeah.
Then with the stock market, once you've got, if you've got 100 shares of Apple, and the stock drops $20 a share, that's going to suck for a little while, but it's going to rebound.
Right.
You're still not upside down on it. You're like, hey, I bought Apple stock for, $200 a share. It was all the way up to $292 a share, whatever it was. So if it comes down to $250, that sucks. I lost a lot of money, but I'm still up. I'm still winning.
It's all part of the gamble.
Exactly. So, and I tell people all the time, I'm like, I'm really careful to ever say that buying a home is an investment. It can be an investment.
Can be.
But the only way you can get the money is to be homeless, or to refinance, which means you're paying money on it anyways.
Right.
So
or never leave.
is it really ever truly an investment? No, not until you're old enough to do a reverse mortgage on it.
Yeah.
You know?
Yeah.
And, you know, so that,
unless you're a flipper, then, you know, get in, fix it, get out, pocket the money. That's really the only time that it's like a guaranteed investment.
Yep. And, you know, and at that point, a lot of people that have a lot of properties, they get into doing the 1031 exchange. And it's like, well, you never really have your money because you're rolling your money into something else.
That's right.
That if you have a loan on, you're paying an interest rate on it. So you're still paying somebody else for your own investment, which is, you know, sounds crazy, but it's reality.
That's how people do it. Yeah, exactly.
Yeah. So, all right. Well, good call. I look forward to seeing the questions for next week.
Yeah, yeah.
Question for you.
Yeah.
On, you posted the last one on Instagram.
Yes.
I can see that you tagged me in it, but when I go to it, that's when I was pushing buttons today. When I go to it, it's just a blank screen.
Really? Okay, hold on.
So I don't know if I need to do something on my side or what.
Okay, so let me show you. Okay, so this is the post, right?
Uh-huh.
Oh, wait, let me go back and start over. Okay,
mine looks like that.
Oh, no.
So
that's because that's in your messages saying that I tagged you. Go back out.
Okay.
That's your messages.
Okay, I thought if I clicked on it, it would take me to it.
No, your messages expire. So if you actually go to my page, this is Sale by Victoria, my page.
Okay.
Not the one that just posted 5 minutes ago, but the one before that with your little face. All you have to do is just click the little watch IGTV black bar right here.
Okay, I see it.
Yeah, so whenever you get messages, it will expire. So you have to go to that person's page.
So I just have to click on your site and then go to that. Gotcha.
Exactly.
Okay.
Yeah.
Cool deal. I'm like, crap, all these people mentioned me in their posts and I can't see any of them.
They expire. You got to go back to it. But the other thing that you should be able to do, let me just show you this really fast. If you're on your own page, there should be a little icon that looks like a little person.
Uh-huh.
That's anything that you've been tagged in too.
Oh, okay.
So like they tagged me in the bowling photo. You know, so if you go to that little person, it should be there that I tagged you in it.
Okay, cool.
Yeah, YPN has tagged me in a few things. So yeah, that's where all that stuff is.
Okay. I was like, I wonder what that button does. And then it was all trying to dial you. And I'm like, oh, in. I don't want to bother her right now.
I'm like, oh my gosh, he's calling me on Instagram. This is so forward of him in technology. How is he doing this?
It was an accident.
I love that you said I'm just pressing buttons.
I'm just pushing buttons.
I should have known. I was like, man, he's smart. He knows to call me on Instagram.
Yeah, no, I'm not that smart. You asked me about some kook writing in an article about our industry. I got you. But you start talking about Instagram, I'm like, what? I missed that. I missed that class.
Oh my gosh, that's so good. Well, thank you so much, Todd. So I'll draft up some questions for next week and we'll go over them before then.
All right, sounds good. Look forward to it.
Thank you.
All right, bye.
Bye.